Taxation. The section will address area taxation, include the general security with the registered representative examination. Keep in mind the securities exam designed to acknowledge that is necessary for the entry-level broker. When in this amount, civil definition will assist you in this section. Earned income. Income most commonly in the form of wages, salaries, however, the providing goods, or for the collecting pension, cashing, and annuity is also classified earned income. Progressed taxes, graduated tax rate will increase your increase in gifts inherent subject to progressive taxes, flat taxes, taxes in which all pay the same rate as sale tax, gasoline tax, tax on liquor, cigarettes. In addition, some states have flat tax rate. Passive income, income received with the taxpayer that does not take an active role, such as a limited partnership, rental, real estate section, direct partnership program, limited partnership, passive income tax, earned income, passive losses only deducted by passive income, deferred income, income earned at the time of tax paid on the income until some time in the future, investment portfolio income, income received resolving owning securities such as dividend, interest, option premiums, capital gains on stocks, bonds, options, futures, sometimes referred to as unearned income. Interest income received on debts issued referred according to the issue candidates, dividends for the taxable years of the paid with the taxpayer paid tax and fully amount received. Many shareholders select not to receive the dividends but to have the dividend reinvested, nevertheless may pay tax for the dividends since for the option receiving them in cash. Job and Growth Tax Relief Reconciliation Act of 2003 changed with the tax of the dividends of the maximum 15% of the 25% bracket above the higher tax bracket, currently 35%, maximum 5% of those of 10 to 15% bracket, effective 2008. 5% rate drops to zero. Qualified dividends generally apply if the dividends received U.S. stock held within more than 60 days within a 120-day period, otherwise will be treated as ordinary income. Alternative minimum tax is designed to make sure that the wealthy individuals pay at least some form of income tax. Just because be aware that certain individuals are subject to alternative minimum tax. Please note that the increased problems of the Congress will likely to have they address in the near future. Real estate investment trusts that do not pay federal taxes, current school and dividends are not qualified tax or ordinary income. Dividends, foreign security, reciprocal dividends, foreign security subject to the requirement of domestic dividends. However, the foreign taxes often withhold. In this case, the recipient still U.S. income tax with net dividend. The amount of foreign tax withheld with the claim deduction against income may be applied with credit against U.S. income tax. Stock dividends split. Stock dividends are not taxable at the time of the received. However, they must be adjusted to the cost-based position of security. A stock split is treated in the same as a stock dividend. Capital gains and losses. Gains and losses result of the transaction. Capital assets of the purchase of the limited of the stocks and bonds options, even if there are many others. Capital loss is deducted with capital gains. Capital losses gains with the further broke down in long-term, short-term holding proceeds per period exceeding 1 year is long-term, less than 1 year is short-term. Should investors experience a net capital loss for the year, it can be employed to produce taxing savings. Next, net losses may be held up to offset $30,000 taxable income any tax year. Should losses of $3,000 balance be carried over to applied against the capital gains of future additional amounts of income of $3,000. If the client would save the tax otherwise would be due, $3,000 taxable income can carry remaining $4,000 loss of 2005. In 2005, has net capital gains of $8,000 could offset $4,000 amount. B taxes remaining $4,000. If no capital gain, 2005 offset $3,000 year taxable income carrying remaining $1,000 forward use for 2006. The wash sale rule. Tax laws include wash sale rules to prevent taxpayers using losses to offset gains and while in effect continue holding similar assets resulted from loss. Thus, in securities hold losses, investors acquire substantially identical securities within a period beginning 30 days before selling, ending 30 days after the sale. Loss of disallowed aided the cost basis of the net security. Example: client owns $10 million in New Cat City at 5.5. One on January 1st, 2015. Bonds purchased on June 1st, 2005. At 92 on December 1st, 2005 to buy additional 10 million bonds. The same description, 10M bonds, 87 December 7th, 2005. He still has original 10M at 86, which is tax situation. Please, the client can use the $600 loss of the bonds originally purchased non-deductible under the wash sale rule. Purchase identical security 30-day period lost $600. 92 to 86 is added to the cost. Second purchase given him on a tax cost basis 93. 87 plus $600 non-allowable loss from the new securities. Please note that the wash sale rule considers purchase security made both 30 days before and after the November 6, 2005 customer sold 3,500 shares tax instrument loss, which used the loss of tax and calculation cannot be repurchased taxes instrument before December 7, 2005, 31 days later, in order could it have been purchased after October 6, 2005, 31 days earlier. This caused the investor to be exposed to the market fluctuation for 30 days. Perhaps the customer sold the stock on November 6, $26 per share. December 7th, the first day he can repurchase. The stock might be at $37. He would have a tax loss, would be probably not be smiling. Taxable tax swaps. Investors can avail themselves of their tax losses by swapping currently owned items for other usual bonds. They do not fall under substantial identical security interpretation wash sale rule. The client might sell the New York State 4.5 bonds due at 6/11/15 at losses by New York State 4.5 bonds June 1st, 2017 has been changed, but both coupon maturity then would be lost for the allowable at year-end. Client wishing to swap make their loss available to broker dealers, provide swap ideas of the clients, improve the maturity or a coupon while getting tax advantage from the loss. In stock, the client might sell one security in which shows loss and purchase similar security in the same interest. For example, the one major oil company stock at loss. Purchase different major oil company stock. Swaps are more generally used in bonds and securities between items greater than stock. Two AA rated bonds with similar interest for maturity dates tend to fluctuate between the same amount. They might not be true or common stock, even though they are the same industry. Accrued interest. Normally, with the buyer purchased bonds, they paid accrued interest in the seller. In case the municipal interest considered to have been paid in issue of the pertaining taxable exempt sales. The seller in multiple positions. Often clients accumulate securities over a period of years. Perhaps the client and IBM overpay. Period of time follows 100 shares at 68 in 2003, 100 shares at 60 in 2004, and 100 shares at 125 in 2005. In January 2006, she wishes to sell 100 shares of ABC at $103 per share. The sale was applied against first purchase made on April 7, 2003, unless she designated otherwise. First in, first out principle is used as a rule. Perhaps the client would prefer apply to the sale against last purchase April 17, 2005 at 125. By doing this, she will choose losses 22 points rather than gaining 35 points. To accomplish this, the seller order would be marked sale versus purchase made April 7, 1986. Legend would also appear on the trade confirmation. She would be able to avail herself of a better tax situation. Alright, corporate taxation. Under present law, taxes imposed with the taxable income corporation maximum rate is 35% of the corporation distributed after-tax earning individual shareholder dividend of the tax-imposed shareholders' rates of the 15%. If the corporation received the dividend from another corporation, received the corporation total deduction excluding the significant part of the dividend of the taxable income of the percentage divided dividend received the deductible variables varies from 70 to 100% depending on the level of ownership receiving the corporation distribution corporation. Receiving corporation owns less than 20% of the distributing corporation. The dividend reduction is less than 70%. Is 70%. Receiving the corporation owns less than 80%, but less 20% of the distributing corporation. The dividend receiving the deduction is 80% of the receiving corporation owns 80% more distributing corporation. Dividend receiving the deduction is generally 100%. The corporation invested common and preferred stake less than 20% issue and received $100,000 dividend in 1995. Would pay taxes only $30,000 over this amount. If the corporation owns 20% or more, 80% of the dividends received. The corporate clients have a good reason to purchase high-yielding stocks. Municipal bonds would be also suitable at the interest except for the federal income tax. Gift and estate taxes. Gift and taxes were imposed in the United States to prevent wealthy individuals avoiding federal estate tax. Past years, people on the means could give away all their assets to family and friends prior to death. When they died, there would be no assets in their estate, no tax due. Person makes a gift of $11,000 per year for the person with no tax ramification. Wealthy woman gives $11,000 a year to each children, grandchildren, friends, neighbors, In fact, anyone with the gifts would not be subject to tax. For husband and wives making joint gifts, the amount increasing to $22,000. Gifts in excess of $11,000 are applied against a unified credit that may be used to defray the tax. Excess gift that reduce person's estate's value of the tax purpose. A woman above gives her daughter $50,000 a gift 1 year and $11,000 would not be considered, but $39,000 would be applied against her. On unified credit, which she dies, the estate would be $39,000 greater than if she had not made a gift of the size. Unified credits offsets $194,200 in gift or estate taxes. Significant change in the Economic Growth and Tax Relief Reconciliation Act of 2001 gradually increases the amount of made exempt. I use a unified credit. The following is table. Alright, 2000, 2003, 1,000, 1 million, 500,000, 2 million, 3.5 million, 2010 repeal subject to sunset provision, 2011 the 1 million. When a person dies, the estate's value with the day of the death against 6 months of the day of the death. The estates can either be valued determined 6 states due, but the remaining unified tax credit would reduce the tax determined of the tax like income tax, progressive tax greater than value higher than percentage tax, while the estates can value with the death. 6 months later, any securities are valued at the same price no matter what the sale was made. Gift certificate, happy birthday, Jeff, with your grandmother. Give the $10,000 stock she was purchased many years ago. The gift does not affect the unified credit. You're certainly willing to accept it. 6 months later, you sell the stock at $13,000. Which tax situation? For the first long-term trade, as you pick up the grandma's holding period, she is owned for the stock for many years. However, the cost of the stock is the donor cost over the value of the time of the gift, which is less. You started the grandmother bought the stock many years ago for $100. That you therefore are long-term gaining on $12,900 or $13,000 the sale price at $100 cost. Hell, grandma bought the stock at $15,000. You would take the $10,000 value with the data with the gift report, $30,000 long-term capital gains. Sale price at $10,000 value with the date of the gift. This would have not been a smart move for grandma's part. She should have sold the stock at $10,000, taking $5,000 tax loss for herself. She could make a gift to you of $10,000 in cash. Taxpayer Relief Act of 1997 and the Tax Relief Act of 2001 gradually increased the state's tax credit at the same time the tax rate with decreasing in 2010 until the state's gift tax is fully repealed. However, in 2011, the state tax returned to 2002. 11 to follow the breakdown in the state's gift taxes each year. Alright, in 2005, the state's holders with dies with a can pass $1.5 million of state tax free. Any excess subject to the state tax and tax indicate the gift tax credit not as large as the state tax credit for gifts that made it 2002 or later with the gift maximum exclusion fixed at $1 million. Only 2011 and state tax credit returned $1 million. Both credits are equal are unified. Alright, the KHOG HR 10 plans. 1960 Congress passed the Self-Employed Individual Tax Retirement Act. Legislation sponsored by the Congress COG of the Brooklyn, New York, an investment made under his loan law, commonly referred to as the COG plan. The law is designed to allow self-employed persons to establish tax shelters for set-aside funds credit for their eventual retirement. Under provisions of the law effective January 1st, 1984, some self-employed made a deposit up to 20% of their earned income, maximum $40,000 annually into an investment approved by the IRS. Services most usually invest programs such as bank deposits, investments, CDs, investment company shares, securities, life insurance, variable annuities, mortgages can be used for these plans. The person may establish a self-administrated plan which permits him the effective trade an account. Person does not have exclusive self-employed to be eligible to COGS. Perhaps a client earns $50,000 per year, but the employee of a major corporation earns an additional money, perhaps $20,000 a year for a part-time self-employed activity. The client might devote weekends selling real estate, landscaping, gardening, counseling on an independent basis. $20,000 such earned could be used on basic COGS plan, allowing up to 20% of the amount of $4,000 to be sheltered. Self-employed doctor earned $100,000 annually could deposit a maximum 20% of the 20% will be deducted. $20,000 will be deducted gross income with a tax purpose saving whatever amount of tax it would have been due. Additionally, earnings of the investment accumulated tax-free unit until retirement. Perhaps the doctor invested long-term corporation bond funds yielding 8%. Income would not be subject to the year that it was earned upon retirement. The money withdrawn is plan whether it would be taxed on regular income, perhaps the level bracket. Maximum deductible contribution of $41,000. Suppose an author earned $300,000 per year for writing mystery novels, she could not deposit $20,000 in COG, as that would amount with $60,000. She would be limited to contribution of $41,000 annually. If a person establishes a COG plan, they must also provide a full-time employee with a plan for any full-time employees defined who have been employed with a minimum of 3 years, who have worked with a minimum of 1,000 hours per year. Thus, an account would work for a writer of 10 years, but only works 1 week a year preparing her taxes would not be eligible. He's 3-year minimum, but not minimum of the annual hours required. Other may also employ the fully secretary who have been employed with the 5 years. The person eligible must provide COG plan, same percentage of her for employers. For example, the employer 13% COG. Should the secretary earn $30,000 per year, employer would have to deposit $3,900 in the COGS in an employee's COG. Unlike many other retirement plans, the employee in the COG plan is immediately vested. Thus, it should leave the current employment plan that goes with her in their property. If the employee has earned an income extremely high percentage figure, she could deposit the COG, but quite small. For example, author earned $2 million per year. Should be limited to maximum deposit of $41,000 into her plan. This works out to be 2% low. Now states that high earning employers cannot discriminate against employees. It must be a reasonable contribution to eligible employees' plan. Money deposited in COGS plan benefit other employee can be withdrawn without penalty beginning at an age of 59.5. Withdrawal must begin at 70.5, and the amounts related to the person's life expectancy. Should a person need to withdraw prior to the age of 59.5, penalty equal to 10% of the amount will be assessed. Should any person need to withdraw $10,000 at the age of 55, a payment penalty of $1,000 will be leveled. Additional entire $10,000 will be subject to the income tax that year. If the needed withdrawal is caused by disability, the penalty could be waived by the IRS. There are many similarities with the COGS and IRAs. The penalty for the withdrawals before 59 requirement withdrawing at 70.5 are identical as COG plan. Amount contributed to the IRA pre-tax deduction for the person's income. And that was Chapter 5. Chapter 6, New York Stock Exchange over-the-counter transaction with the NASD, National Association of Security Deposits.